Hello, my name is Benny Tavares, and today we'll be discussing regressive and flat tax states for Tax 6935. Today we'll review two states' taxing systems and compare them while looking at interesting facts. We'll see the recent tax changes that are affecting each state and conclude with questions. Washington, the only state to be named after a president, is ranked #1 most regressive state in the nation. Regressive states gain a lot of their tax revenue by heavily taxing the poor and middle class. For example, Washington's 20% poor is taxed at 16.8%. Their 60% middle is taxed at a 10.1%, while their 1% rich, 2.4%. Michigan, home to Detroit, car capital of the world, is ranked by Tax Foundation within the 10 worst business tax climates, and which is based on a bunch of different factors that we'll be reviewing. Today's state's taxes that we're checking out are income tax, business and occupation tax, property tax, use tax, retail sales tax, which gives us a good tax environment to understand each state. Income tax. Washington luckily doesn't have any, not even on retired income. However, one of the state's secretary is thinking of bringing up income tax for educational funding. Michigan has a flat tax of 4.25, which is assessed on a single factor, income earned, making it the 12th lowest in the nation. We have business and occupational tax of Washington, which is a flat tax assessed to different industries such as retail, wholesale, or manufacturing. This tax is based on gross business income, and it's on a 3-factor, which is sales, property, and payroll, summed up and divided by 3. Michigan has a flat tax of 6%, split 4.95 for income, and then 0.8 for modified gross receipts, up to 1. We have property tax, which is assessed on all real, tangible, and intangible property, which makes up 30% of Washington's tax revenue. There are certain exemptions and programs for exemption. For example, the elderly program, where if you're over the age of 61 and permanently disabled, have less than $35,000 gross disposable income, own your property, and lived in it over than 6 months, you're exempt from property tax. However, if you're not over the age of 61 or disabled, you can enter a program if you have less than $35,000 disposable income. There's a deferral program for 35 between 40, which allows the state to pay for your taxes, but must be paid back in the future, and allows the state to gain a lien on your property. Michigan, however, assesses your property at a 1.05 rate, or section 211.27A inflation rate, while Washington does 100% fair market value of your property. Michigan, however, this year has done about $1,344 per person. Then we have retail sales tax. For Washington, the retail tax is 6.5 by the state. However, they follow a destination sales tax, which only affects sales made within Washington, but it's dependent on where the sales are going to be ending, like the destination. And a combination of both gives it the 4th highest at 8.8 for state and local sales tax. Native Americans, interesting enough, aren't taxed on their sales, especially when it's in their territories or for sales destined to be in their territory. Michigan has a flat tax of 6%, which follows a single factor, sales, which is similar to use tax, which is applied to any property used within a state that hasn't been attributed a sales tax by a state inside or outside. Washington's use tax will be written in onto the 1040, and Michigan's use tax is a flat 6%. So you're either paying the use tax or the sales tax, one or the other, not both. And they're based off a single factor. So all these taxes, income, business, property, use, retail, gives you a good understanding of the tax environment. However, the Tax Foundation uses different factors to assess the business needs. For example, corporation tax, income tax, sales tax, unemployment tax, and property tax, to give a summation of what ranking or what businesses would like. That's why Michigan is ranked #7 under 10 lowest for businesses, and while Washington is ranked #27, which makes it a good business environment. Recent events are happening within our nation is tax shelters closing. For example, 2015, we have the active finance exception and the controlled foreign corporation look-through rule that has been applied by multiple of different organizations using foreign subsidies to shelter their income. For example, GE with 18 controlled subsidies abroad sheltered over $199 billion from 2008 to 2011. This gave them a negative tax rate of 7.3%. These big companies with these tax shelters are skimming and forcing all the tax debt on to small businesses and individuals. They are sticking them with the bill. So the closing of these tax shelters will save Washington, small businesses, and taxpayers alone $80 billion in raised taxes due to needed funding, especially in Michigan too. So the fact that these close are great, but however, a lot of companies are lobbying. For example, GE hired 48 different lobbyists to argue and keep up this tax shelter. Next, we have our conclusion, which comes with questions. So thank you for listening, and I hope you enjoy. Which state would a high-income earning person prefer to live? 2, based on the information provided, would a business be most likely to incorporate in Michigan or Washington? And 3, who benefits from a regressive tax system? Thank you very much, and I'm Benny Tavares.